The Asian Development Bank has lowered its growth forecast for most Asia-Pacific economies, citing high global interest rates and China's weakening property sector.
The outlook was trimmed from 4.8 to 4.7% for so-called developing Asia countries, a group which does not include Japan, Australia and New Zealand. However, the bank is sticking to its 4.8% projection for next year and predicts average inflation will ease by the end of 2023. Well, Albert Park is Asian Development Bank's chief economist.
I think the main factor is that for many economies in the region, domestic demand remained relatively robust, still coming out of the pandemic, and that countered the slowing external demand. In particular, China, of course, opened up in the first half of the year, leaving the zero-COVID policy behind, which really doubled their growth rate relative to the second half of last year. So those factors were important. We also had rebounding tourism in many countries. We had pretty healthy remittances, and we had improving financial conditions in the region, which all helped contribute to a good performance in the first half.
However, before we get too cheerful, your report revises the growth forecast for the region for 2023. Why is that?
Well, we're revising our growth forecast down just by 1/10 of a percentage point, from 4.8% to 4.7% this year. And the reason is, I think the most important reason probably is that the weak external demand for exports out of the region was a bit greater than expected, especially for electronics, semiconductors, machinery. And this weighed on a number of economies, especially the high-tech exporters like Taipei, China, and Korea, Singapore, etc. But also some countries had weaker demand for textiles like Cambodia. So this was another reason. And the last reason is that weather has been actually very bad in a number of countries. So the monsoons, rains in India were poor, and that led to food price inflation and diminished expectation about how agriculture would perform this year.
The report says some central banks in the region have started loosening monetary policy due to subsiding inflation. How do those monetary policy adjustments contribute, if they do, to boosting growth?
Well, last year, as the advanced economies, in particular the U.S., increased their interest rates to combat inflation, many of the economies in Asia also had to increase their interest rates to control inflation and also to avoid money flowing out to the more attractive U.S. currency with a higher interest return. But now that inflation is moderating and the U.S. Fed tightening is slowing, a lot of economies are anxious to continue to support economic growth in their own economies, and that's facilitated by lowering interest rates. Some economies have started to doing that, in particular China, Sri Lanka, several countries in Central Asia and Caucasus region. And what lowering the interest rate does, of course, is it gives a greater incentive for investment. It makes credit also less costly for consumer purchases, housing purchases. So this is generally considered good for growth. Also, it could lead to slight depreciation of the currency, which actually supports exports. So these are all channels by which interest rate adjustments, downward interest rate adjustments, can support growth.